Hello, ladies and gentlemen. My name is Greg Michalowski. We're getting a risk event right now. As a matter of fact, Bank of Canada cuts benchmark interest rate to 0.75%. So let's just preempt our webinar here just for a second and take a look at what that has done to the dollar Canada here. Move the price sharply to the upside here. Most people were expecting that the Bank of Canada would do nothing here today. So this is the second shock that we've seen in the last few days of trading. The bias is to the upside here for the dollar Canada, a weakness for the Canadian dollar as a result of the oil prices. The Bank of Canada is citing oil shock boosts, downside CPI, says financial stability risks as well are increased. This delays a full economic recovery to around the end of 2016. So this is a big event here, a big risk event. Wouldn't necessarily, the bias was to the upside coming into this decision. We're trading at the highest levels going back to 2009, and now we're trading at even higher levels going back to that same year in 2009. So we're kind of in nowhere's land here for the dollar Canada, and that's what we're seeing here, just to boost the upside. Going, off of this move to the upside, what traders will be looking to do. First of all, I'm not in the position to sell, or traders should not be in the position to sell. If they are short, look for opportunities to buy. And what I like to do is put a Fibonacci retracement from the low to the high, and then retrace down toward the 38.2% retracement. Should not go below the 50% retracement, but in this area right here is where traders should find the price finding support, as long as we don't continue to the upside here. Right now, it's hard not to buy the market if you're short. Why? Because this was just a shock to the market, so we're seeing continued buying. I assume that you can hear me, right? Can people hear me? Okay, good. All right. There was there's always silence here, and you wonder, can you hear me? Okay, good. No, I just stopped right at the top. Started right at the top. I get it. Okay. All right. So Bank of Canada here pushing the dollar Canada to the upside, and the Canadian dollar to the downside here with the surprise interest rate cut. Cuts their 2015 growth outlook to 2.1% from 2.4%. So a big surprise here. Watch the retracements here in the dollar Canada. If you're not in it, the horse kind of left the barn already, and that's why you look for these retracement levels. Market should find support in this area right here. Let's watch the 38.2, 121.93 level. I know we're about 50 pips away from that, but any dip is probably going to be bought here for the for the dollar versus Canada. You never know who gets off sides as a result of that. All right. With that said, I did sign up for a talk here, talking about risk in the Forex trading. It was just I didn't sign up. The good people at Forex Street FX Street allowed me to participate in this once a month, to be able to speak with you about different topics. And I thought we'd talk a lot about risk in the Forex trading before we get started. The risk disclaimer: trading foreign exchange carries a high level of risk that may not be suitable for all investors. In addition to that, leverage creates additional risk and loss exposure. Should you decide to trade foreign exchange, carefully consider your investment objectives, your experience level, and your risk tolerance. You can lose all or part of your risk capital, so be aware and be prepared. So who am I? I've been working in the financial markets now for, well, a little over 28 years, I think. 15 years, the institutional side of the market, Citibank and CSFB, as a trader in interest rate derivatives, to be honest with you. foreign exchange, but the last or 13 years then it's spent with FXDD. First six or 7 years mainly focused on the risk management side. So again, on the trading side, the last 5 or 6 years as a Forex analyst, coming to you in that capacity, author of Attacking Currency Trends. You can find it on Amazon or on my website, or send me an email and I'll can PayPal or whatever. Since September 2014, I've been director of technical analysis and trader education at forexlive.com. So my background has a lot of just number of years experience watching the markets day in and day out for 8-10 hours a day, and also from the institutional side over to the retail side as well. So come with you with that type of experience. If you are interested, just a little commercial for forexlive.com. You visit and subscribe to our YouTube channel. That's at Forex Live Analysis, or just query in YouTube Forex Live and you'll get there. Also, we have obviously our daily Forex commentary that you can find at forexlive.com, where Adam Button, the FX Person of the Year, as proclaimed by, as announced by FX Street, is a contributor, of course, along with myself and Ryan and Mike and Eamon. We take you around the clock in your Forex news. This is a comment that put up back at last time. The Swiss National Bank, prior to this move by the Swiss National Bank that we saw last week, prior to this move, we taught the Swiss National Bank did lower rates to negative interest rates. And my comment there, because I'm not more of a technician, the US dollar and Euro Swiss get a boost, but what are the charts saying? What are the charts saying? We'll talk a little bit about the charts, but we're going to talk more about risk in trading, and in particular, a little bit more, a little bit about that S&B decision and mindsets on risk and who's to blame a little bit, and stuff like that. Some of it might be a little bit hard for you to take, or take, especially for people who may have been caught in that Euro Swiss move and still unsure of what the future might bring as a result of it. So it's time to kind of rewind and to reevaluate. And if you didn't get caught, this is a time to think about, okay, well, what are the risks that we face? We just saw a risk event with the Bank of Canada interest rate decision, and I'll talk a little bit about something like that. We have another risk event tomorrow with the ECB interest rate decision coming out at tomorrow morning at 7:45, and then we have the press conference by ECB's Draghi, and they're supposed to do something tomorrow. That's expected, but there's still a lot of uncertainty as far as that risk. So we'll talk about it. Last week's action from the S&B, it was somewhat historic and an epic error in judgment, and that judgment or that error came on the side of risk. And the error in judgment can also be applied to brokers and even to you traders as well. So we have to take our, sometimes look ourselves in the mirror and understand that, sometimes the fault is not necessarily always on the S&B or the brokers, or, it can be put on ourselves. And I'm going to hopefully go through how you may have, been able to avoid that by just having a keener understanding of the risks involved with that trade. It's easy to say in hindsight, but there are some clues, and some of them, one of them was in that, that comment that I put on Forex Live about the risks. What are the charts saying? And so I'll go through that in this discussion and trading in our webinar here today. But aren't the huge errors in judgment always centered on poor assessment of risk? If you go back in time and you take a look at some of the biggest blunders and biggest failures that we've seen, a lot of times it has to do with the risk assessment and not understanding really truly within a margin of error what the risks are, excuse me. And there is a book published about when genius failed, and was talking about the rise and fall of this long-term capital management. So what was long-term capital management? Well, this was something that occurred in 1998, 1999, actually when my banking career ended at Credit Suisse First Boston. It was kind of an offshoot of this problem, because the Swiss National or Credit Suisse First Boston was pretty involved in this failure, and also in the Russian debt crisis that led to long-term capital management failing as well. So they were kind of along with long-term capital management, and as a result, the bank cut a lot of people from the payroll at that time. One of which was myself, but don't look back at it with any regret. The last 13, 14 years have been one of the more rewarding years from a job standpoint. So I don't have any problem with that. So anyway, long-term capital is a hedge fund based in Greenwich, Connecticut that use absolute return trading strategies combined with high financial leverage. Remember that word, leverage. Okay. Now, it was founded by some pretty, influential and sort of icons in the market at the time. A guy named John Merriweather, who was the head of bond trading at Solomon Brothers, and he bought on people like Scholes and Merton, who were shared the Nobel Prize. You remember the Black-Scholes option pricing model? Well, he was part of the board of directors, and so they had these Nobel laureates, these quants, everyone of anyone and it was kind of like the who's who, the all-star team, the Pro Bowl, if you will, of the financials, all getting together in this one firm, manage money, blah blah blah. So, but their gig was taking high leverage positions to make a significant profit, and they had equity of 4.7 billion at one time, and but they leveraged that up to a tune of 25 to 1, and then they also they did that by taking in on off balance sheet products like derivatives and such, and this increased the leverage for the firm, and they're trying to make a little off of this leverage. Make a little off of this leverage. Does that sound familiar with the Euro-Swiss situation last week? Trying to make a little off of lots of leverage with uncertainty about what the downside risk was. So everyone was focused on the reward at long-term capital, about making these great arbitrage bets that just can't go wrong, and squeezing those last few basis points or whatever out of the market. But they did it through using leverage, lots of leverage, very risky indeed. The U.S. Another big example, U.S. subprime mortgage debt crisis, and give mortgage to anyone for little or no money down on the back of expectations. Prices would continue to go up. Lots of leverage in owning a house with 0% down. Lots of risk with giving out loans with 0% down. And this is a little graph of the securitization of some of those mortgages and how the market got way out of line here. 23.5% of all mortgages originated were subprime, of the subprime variety. And you can see how not only that, but how the securitization of these loans grew at multiples of what it was in the past, and this created this this bubble, this huge bubble. No understanding of risk, none whatsoever about what the implications of this chart was on the market, on the economy, on the global economy, and we know the result of that. Very high leverage, very big risk, and little upside potential. To be honest with you, what were the banks? The banks were just getting a mortgage payment, right? So they're making these loans out, they're getting a mortgage payment. They're just doing a lot of them, very risky. And of course, this is very risky as well. I had to put that in. Anyone who marries Kim Kardashian taking a lot of risk. So risk, and evaluation of risk, and all that idea are tend to be huge errors in judgment. When we have these big blowups, they tend to focus on a huge error in judgment on the risk associated with marrying Kim Kardashian, with making subprime loans at 0% down to just because the price of houses are going, of leveraging up in Russian debt and all sorts of arbitrage opportunities, just try to make the last little cent by doing a lot of them and controlling this market and being the big boys and taking this quote unquote arbitrage profit out of it. It ain't gonna happen. Well, last week with the Swiss National Bank did a risk, or not last week, but over time, the Swiss National Bank has taken a big, huge, risky bet as well, and they took this huge bet by installing that floor, if you will, or that cap, depending on which way you're looking at it. They say a cap because it's capping the Swiss franc rate, which was being bought up. But when we look at the Euro Swiss on the chart, obviously it's a floor at the 120 level. So it means the same thing for you people out there not understanding what the cap and why is it called a cap and why is it called a floor at the same time. It depends upon how you're looking at it in terms of the Swiss franc or in terms of the Euro Swiss as a interest rate or as a Forex rate. So And here's what happened here. Back in 2011, we saw the the Swiss franc, and in particular the Euro Swiss, was under extreme pressure here to the downside. Why? Because of all the issues within the Eurozone and was leading to this flight into the relative safety of the Swiss franc. And so back in September 6th of 2011, they set the Swiss National Bank came out and said, we're going to set a cap on the appreciation of the Swiss franc, or a floor here for the Euro Swiss at the 120 level, and the price will not go down. We will defend it. We will defend it. We will defend it, is what they said. And when you artificially defend something like that, you create this false type of market. In the absence of this floor right here, this cap, the market would have gone lower. Okay, let me take a little break here because Sandy's asking about arbitrage. Please explain. Arbitrage is when you try to take advantage of mispricing of similar but different instruments. So just a quick example. So you have Pepsi and Coke. Well, they're both colas, right? And so they should kind of move along at the same pace. And one may get overbought relative to another one, or vice versa. And so there may be quote unquote arbitrageurs out there who try to take advantage of the spread between the price of Pepsi stock and the price of Coca-Cola stock. Obviously, there's risk involved there because the spreads can go wider and lower. So that's what an arbitrage is. Now, in the case of long-term capital, they were, I don't necessarily want to go into too much detail in regard to what they did because it's kind of complicated, and I can do a whole seminar or webinar on it in particular. But they were more involved in the debt market, trying to take advantage of differences in the interest rates of different products, like U.S. Treasuries. U.S. Treasuries versus U.S. Treasuries, and also different countries' interest rates as well, Russian debt versus U.S. debt type of thing. So that's what it was about. Okay, so in any case, what happened here was that they created this floor, and this floor worked for a while because it took out some of the speculation in the to the downside, and certainly kept the price above that level. But as time goes by and as that floor is tested, the Swiss National Bank had to defend it. And how do they defend it? They defend it by buying Euro Swiss. So they're buying Euro and selling their own currency out, and that keeps a bid in the market here. As that happens, the balance sheet of the Swiss National Bank balloons up with euros basically and other currencies that they bought against the Swiss franc. And so that leaves a huge a distortion on their balance sheet and also puts them at risk. What is the risk? That the Euro Swiss goes down or that other things happen that keep the Euro Swiss under pressure and the Euro Swiss has to fight the rest of the world against their currency and against their own currency. And so what we saw is that it worked for a little bit. We got actually the price up here, the 125.66 level, 126.46 level. And the error that the Swiss National Bank did, here's a little closer, the moves to the upside here, right here and here. The error that the Swiss National Bank, in my mind, did, the biggest error in risk judgment, was not what happened necessarily over here, but it's what didn't happen over here. The Swiss National Bank put that floor in to keep the price from moving lower. Well, what was the price doing here? It was moving higher. It was moving higher. It was above the 120 level. Now, it's only 300 pips to the upside there, 300 to 600 pips to the upside away from that 120 level. But the error in judgment, I believe, was that the Swiss National Bank failed to understand the risks involved with having a floor and understanding that the floor probably couldn't stay there forever. But if there was a fundamental reason that caused the Euro Swiss to move to the upside through this area right here, they had an opportunity to take that floor off. Now, it may have sent the Euro Swiss down below the 120 level, but at least it wasn't in this environment where these were occurring. It was when the currency was being sold. And so they had the opportunity to take off the peg at this point right here, and maybe install other actions, like they could have lowered rates to 0% at that time and said, our currency is still overvalued. We still are in the background there. We could come back in and put the floor back in and just scare the market that way. Scare the market to where the imbalances from this artificial floor where traders just continually come in against the 120 level thinking that it's going to last forever and ever and ever. Amen. Get them out of the market, to get that imbalances out of the market, and they were truly building. But so their failure came here, and what we saw through 2014 was instead of the market finding support, let's say against a 200-day moving average, like it did here, every time the market came to the 200-day moving average, it moved higher, and things started to turn in this area right here. And now we started to see the moving averages move to the downside, and we started to see more selling pressure. Why? Because the Eurozone wasn't rebounding. And so we had other problems like the Russian debt crisis, the Russian problems with the Ukraine. That also led to a flight into relative safety of the Swiss franc. Russians in general were, because they were having controls put on their economy and the ruble was getting hit. They were just selling rubles and buying Swiss francs and buying real estate in Switzerland. They were pushing the market to the downside, and so the things started to go wrong through here. But the big problem was over here when that was a big error in judgment on risk, in my opinion, by the Swiss National Bank at that point. A clue here, or one of the things that happened here at this point right here, was that the Swiss National Bank went to negative interest rates on December 18th, and that's when I wrote the post. What are the charts saying? And the charts are saying it went above the 100-day moving average for the first time. We only spent 10 days above the 100-day moving average through here, or I think actually less than 10 days. I think 5 days through here. And the market got above that level, couldn't stand above that level, and started to move to the downside. So risky situation up here at the tops right there. So when the dam finally broke last week, what happened? There was no stopping the fallout from the amount of orders being triggered. We all know that it's it's water under the dam right now, and there's been a lot of damage done within the market, and there've been definitely winners, and there's been definitely losers, and also some winners as well. Some of the losers, Swiss exporters. If the Swiss National Bank was trying to defend those exporters, then they're now doing a horrible job because the Euro Swiss is down much, down toward the parity level now from 120. So they're hurting. Swiss tourist industry hurting. It's more expensive to go to Switzerland. Lower prices of imports could cause deflation in Switzerland. That could lead to a slowdown in the economy as consumers hold back on purchases, expecting them to be lower down the road. Those with Swiss-based mortgages, they're hurting. People in Hungary and Poland took out Swiss-based mortgages. Now they have to pay higher for the Swiss franc on a monthly basis to make their mortgage payments. And so that's a big hurt for them. Took a hit. Swiss National Bank took a hit on their holdings of euro and U.S. dollar. So as a central bank, they lost in their own decision. Forex brokers, we know, and banks took a hit, and most retail Forex traders. Winners, Swiss importers are cheaper, so there is some payback because the imports of parts or oil or whatever, that is going to be cheaper. So there is a little bit of a benefit because of a stronger currency. European businesses who export goods to Switzerland, they're big winners, or should be winners. Not necessarily big because it's but still relatively big, or better than it was yesterday. Swiss savers, they now have a stronger currency. You can go spend their money overseas or in Germany, cross border, go buy their groceries there. Forex brokers and banks, and small amount of retail Forex traders. But what I want focus here is the retail Forex traders. Most retail Forex traders lost money, and in fact, if you were to look at the broker data, the positions within the Swiss franc were heavily skewed, or the Euro Swiss are heavily skewed toward the long side, to the point where it's like 80, sometimes even above 90% of the what were long. And so when you say that the winners were perhaps brokers and banks, well, that someone had to take the opposite side of those positions, and those became the winners, because the retail traders were mostly long the Euro Swiss, and looking for that move to the upside, looking for that small gain to the upside. So why did the S&P do it? Pressure from the EU, ECB was growing, likely not going away. We know that. Tomorrow we're going to have that decision by the ECB. And the balance sheet just became too big to continue to support the peg as a result. And so this is a fundamental thing that we, maybe in evaluating the risk of the position, should have, as traders, should keep should have kept an eye on that fundamental fact. We know if I were to interview all those people who are long Euro Swiss or long dollar Swiss last week before the decision, ask them, what do you think the ECB is going to do next week? Probably 90% of them would probably say they're going to do quantitative easing. Well, what should that do to the price of the euro? It should weaken the price of the euro, or that is a risk. And what is the euro doing? Well, it's getting weaker because inflation's coming down, a deflationary environment. All these little things, folks, you have to pay attention to and stop yourself and ask the question, what is my risk? What is my risk? I know the S&B's on the other side. I know they said they're going to support the currency, but what about the risks? What about the risks? So those were the fundamentals. So why did the retail traders all lose? Those positions with the Euro Swiss and the dollar Swiss were all long. And so who's to blame? Well, most are blaming the S&B and the brokers. And as mentioned, I blame the S&B. I thought mainly for not doing something in the past, for not taking away that peg, for keeping that artificial floor, if you will, in there for the Euro Swiss. I blame them for not looking to get out of that powder keg type status where things could really go horribly wrong. That's my main blame toward them. Last week, what they did, the timing couldn't be worse. Okay, so I blame them for that because they did it when the Euro Swiss is at 120. Right at the lows, there was a lot of pressure in that pressure cooker, and they didn't understand the risks involved with what may or may not happen. I think if you ask them, and they've stated that I don't think they thought that the price would go 3,500 bips to the downside. So why do we blame the S&P? Or why do most retail traders blame the S&P? Well, they said that they maintained the cap at 120 versus euro, and they did not. And that's a standard answer that a lot of people say. They lied to us. They lied to us. But we as retail traders have to be skeptical about what people say and what and focus instead of what are our risks. What are our risks as a trader? And you should always, always, always try to define and limit your risk. This is why I say those words every single day, or type them out. You need to define and limit your risk. You need to understand where your risk is. This is the risk. This is this is what we're what you're facing as far as a risk, the risk for your trade, or where the risk is for this currency pair, or what potentially could go wrong. It's not the reward that we should be focused on. It should always be the risk that we're focused on. And so if risk cannot be defined and limited, the risk can be therefore unlimited. Have a certain amount of liquidity, then the markets are going to move. If you're trading a penny stock that has no one following it, then it's not going to move. So there's really little. Well, there's event risk and liquidity risk there, but there's little market risk of a movement if it doesn't trade. But we know that in the foreign exchange market, every currency pair moves, and so we do have market risk every day. So that is what we try to define risk and limit against by using technical tools. And then we have these other risks called event risk and liquidity risk. And when I ask you, or do something along those lines, and that becomes an event risk. And we have to try to understand and ask ourselves, is there any event risk going on that is going to increase our risk overall above and beyond the market risk that we face every day? Now, I'm not trying to scare you in thinking that the housing starts and building permits that come out in the U.S. today is an event risk that you should be scared to death about because the market's going to move 3,500 pips. That's not the same thing, okay? That is an event, that is some risk, but in relation to a peg and a floor, peg rate being moved or gone through and stops being triggered because 90% of retail traders and other traders around the world are long the Euro Swiss. That is event risk that you should pay attention. That should be in your mindset. That might stop you from going out and doing something in that currency pair. So we have to be cognizant of the three types of risks: event risk, and the last type of risk is liquidity risk. And liquidity risk happens when the event risk occurs. Typically, when event risk happens, and depending upon how big that event is, the liquidity risk dries up, or there's increased liquidity risk. And we saw that. We saw all those three things explode when the S&P made that decision to get rid of the peg. Could you have anticipated that the Swiss National Bank would do it last week on that day at that time? No. But should that event risk been a little bit in your mind? A little bit. Okay? A little bit. So you had to understand that. The peg is the artificial exchange rate that the Swiss National Bank kept the Euro Swiss at. So a peg was the Swiss National Bank said I don't want the Euro Swiss to go below the 120 level. So whenever the price went down to the 1.20 level, they were a buyer. They came in and bought the Euro Swiss. So anyone who sold to them would sell to the Swiss National Bank, and the Swiss National Bank would buy. So they're just like any trader out there. So they pegged onto it. They held on to it. Okay, so putting it another way, so let's go back to our question. If there was a chance that the peg was abandoned, that there is an event risk, would you be in the Euro Swiss or the dollar Swiss? And and the answer is probably no. The answer is probably no. But the answer also may depend on what would be your perception of the reward and the risk. Okay, just generally speaking, if you know that the Swiss National Bank is going to has a possibility of taking away the peg, you might say no. But you also have to think in terms of, well, they haven't done it yet. Why would they do it now? And that's where people got a little bit skewed away. And so you have to look at the risk reward. And I go back to this chart of the Euro Swiss to try to define the reward first. Now, I know I said you should focus on risk, but let's look at the chart and try to make a judgment. Again, it's a judgment, and we don't know for sure. But we do have a history here in the Euro Swiss that might give us an idea of what is going on above the market if you were to go long the Euro Swiss. And so we're drilling down just a little bit further to understand a little bit about the upside potential, the reward potential. And we know because we're astute traders that there are certain things that may have caused things like this to move. And that was when the Swiss National Bank lowered the rates to negative in a surprise move on December 18th. And that was so now any deposits that go into Switzerland as a result of a flight into the safety of the Swiss franc are going to have to pay the Swiss National Bank money for having those deposits in their country. So that's a deterrent to buying the Swiss franc, right? And so we saw the Euro Swiss move to the upside. And where did we go above? We went above this blue line right here as a 100-day moving average. And this is why I use technical levels, ladies and gentlemen, is because they give you an idea of what the market is leaning against, what the market is looking at. And you'd be surprised how many times the market will come up to that 100-day moving average or 100-hour moving average and sell off, or come up to the 100-hour moving average and sell off, or come up to the 100-hour moving average and break through it like it did on this day right here on the fundamental news that the Swiss National Bank was lowering rates to minus 0.25%. But when I said in that piece that I wrote back on December 8th, what are the charts saying? In my commentary, I said the price is back below the 100-day moving average. So the price moved above the 100-day moving average, and the price came back below the 100-day moving average. Sellers in the market took the price back to the downside. So all these people who are long down against the 120 level, they took their profit against above. By the way, there's only 6 days back here where the price closed above the 100-day moving average. And prior to that, you have to go back to January, the last time. So for nearly a year, there may have been 20 days at the most where the price traded and closed above the 100-day moving average. The rest of the time, below, 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 below. So this was a clue, folks. This was a clue from a chart that told me something. It told me that the potential reward of owning the Euro Swiss at 120, in the face of the fundamental stuff like the Euro ECB lowering or doing quantitative easing, because that's kind of the equivalent, or that's bearish for the Euro Swiss, but the potential reward is only 49 pips. is only 49 pips, because if they're going to cut rates by 25 to negative, and we can't get and stay above the 100-day moving average, there's going to be sellers up there again. So what would cause a rally reward? Answer: ECB not easing, stimulating as much. That's probably not going to happen. S&B intervening even more. Those are two things that you'd hope for from the long side. What are the chances of this happening? Not much. Deflation. There's just, inflation keeps on coming down in the ECB, and they keep on talking about it. So it's no surprise that they're going to likely do something tomorrow, or the chances are pretty high that it is. And then S&B intervening. Well, they've been doing it. So what was the risk? Probably have a chance to get. So if we know the reward is 49 pips, what would then be your assessment of risk? And honestly, if you ask me that, I would probably say you probably get a chance to get out at 100 or 200 pips. In hindsight, it wasn't even near what you could have gotten out at, was it? It was much more. But you have to put some judgment as far as what the price could have gone down. That was just a guess. That was just a guess on my part, being totally honest. So 49 pips. 200 pips of losses. So is that a good trade to make 49 pips to lose 200 pips or potentially 200 pips? And the answer is no. I think most people would say that. Now, if you took a chart view of it, that 100 to 200 was just my guess. If I were to really look at a chart and try to equate what taking away the peg would do, a smart way might be to go back to the time when the price was below the peg here and see what happened when they instituted the peg. So when the peg was set back here in September 10th of 2011 or 11, the market moved 1,100 pips to the upside, 1,100 pips. So the market was down here back in 2011. What is to prevent it from getting back down to that 08 to 10 level? And quite frankly, some people from the Swiss National Bank finance minister came out and said over the last few days that she expects that the Euro Swiss will settle somewhere around the 110 level. Why? Because that's where it kind of settled here. It was in a free fall here. It came back. We kind of gapped right here, and then it kind of came in toward that 110 area right here and was trading in this area right here around the 110 level. So that's where I think the Swiss National Bank thought that the price would go to. It went to 85. So well below that level. But if you take a look at the chart and you don't just guess like 100 or 200 pips, like I think a lot of people might have said, that in reality the price could have gone all the way down 1,100 back to the 110-ish type area. So about 1,000 pips to the downside. That should have been something more realistic. So as a trader, we need to be sure to make these types of broad judgments sometimes. We need to ask, what if? And if the risk is not easily definable, we need to stay away because we really don't know. We really don't know. And if the undefinable range is 100, 200, 1,000, that is just too wide a range to be playing for 50 pips. I know it's hindsight. I didn't have a position in Euro Swiss one way or the other. I stayed away from it. In fact, that December 18th post was the last time I wrote about it, because no one wants to hear about it. No one wants to hear about the Euro Swiss that's trading in an 8-pip trading range. But you need to do these types of judgments as far as trading go. You need to ask the tough what if questions, and make the judgment that this could be a disaster, especially in light of the fact that the price, especially in light of the fact that the price went above the 100-day moving average when the Swiss National Bank did their last hurrah, and it couldn't stay above that 100-day moving average. It needed to raise a red flag in your mind that said, get out. And there have been people who have expressed on our website at Forex Live that they did that. There are also brokers who raise the margin requirements and stuff, and that was another hint that risk is too high, folks. If it's too high for your broker who's trading against you, it's too high for you too. All right. The other thing that we should do in finishing up here a little bit here is talk a little bit about the 2 to 3% of the account risking of maximum risk limits on trades. Okay, this is just in general again, and you know the other part was in general as well, and you know maybe related to the ECB decision tomorrow, but we also need to understand about the 2 to 3% of the account balance. Okay, any one trade that you have, and this gets back to leverage as well. 50 to 1, 100 to 1. I don't really care about that. The only thing that matters is 2 to 3% of the account balance. You're not going to survive in this in the foreign exchange market if you risk more than 2 to 3% consistently. If you risk 5%, 10%, it's just not going to happen. You're gonna have times when you're gonna lose 5 trades in a row, and 50% of your account balance is gonna go out the window, and you're gonna try to trade it back, and you're not gonna be able to do it. All right. So the only way to stay in this game is the only way to play this game for a long time is to stay in the game, and the only way to stay in the game is only risk 2 to 3% of your account balance. So what does that mean? Okay, and from a perspective here. You have a $10,000. I'll get to your question, Linda, at the end. Okay, so you have a $10,000 account balance. What is 2% of that value? $200. $200. So what was the euro sort of value of a pip in dollars before the decision? And this is kind of an example of what you should go through to kind of figure out, well, how much, if I want to go into the euro Swiss, what type of position should I have? If I think that the market's going to move 200 pips, what position do I have? Or that's my risk. If my risk is 1,000 pips, what is my risk? What kind of position should I have? So if the euro Swiss moves a pip, what is the P&L? And the answer is 10 Swiss francs, because the quote currency is a Swiss franc. So every time the market moves a pip, you're going to make 10 Swiss francs on one lot. Okay, one lot position. So what is that in US dollars? And what you need to do is convert the 10 Swiss francs into US dollars. And so what you need is a US dollar Swiss interest rate. And you can find this in calculators online as well. Just put in PIP calculator. FXDD has a good one, so you can go there and find it. So $1 US equals 1.029 last week before the decision. So if you're looking for how many dollars is equal to 10 Swiss franc, so you just put this, this is the old ratio. 1 is to 1.02, not 219, as X is to 10 Swiss francs. So we have 10 Swiss franc. What is the X equal to? And X equals 978 per pip. So last week, the value of a pip for one movement in the euro Swiss was $9.78. So if the risk is $200 that you can lose 2% of your account balance, and you did one lot, your pip risk would need to be around 20 pips, because it's 978 times 20 pips equals about $200. It's a little bit more. You can do 1 point something lots, but just round it up to one lot. So in theory, if you thought that the market would move 20 pips, you can do one lot. Well, my guesstimate was that it would be 100 to 200 pips. That was just a guess. It wasn't looking at the charts, it was just a guess. What amount should a trader do? And so in order to do that math, you take 100 pips times 9, gets 978. That would be the loss. You take the $200, that is your maximum loss divided by the 978, and you get 2.04 of a lot. So if you did 2 mini lots times 978, you would have a $200 loss, and you lost 100 pips. The margin for that two mini lots would only be $475. $475. Now, for you people who like to use leverage in the foreign exchange market, what am I saying by risking 2% and doing the math about what my maximum risk of 100 pips would be? What am I saying about, when I say that you only use $475 of your margin for that 2 mini lot position? I'm saying that don't use leverage. Instead, focus on that 2 to 3% of your loss of your account balance that you're willing to lose on this one stinking euro Swiss trade. Focus on that and not the leverage. Leverage gets you in trouble. I know you've heard it 1,000 times, but leverage gets you in trouble. So if you were fully leveraged up, you would use 10,000 of your margin. You have $10,000 in your account. I'm only using 475. You would use up to the 10,000. Fairly margin, you could do 4 lots. So I'm suggesting, because I'm only going to want to risk 2% of my account balance, and I think it's going to move 100 pips, that I should only do 0.2 lots. If you're focused on leverage, which is a mistake, just like traders who focus on reward is a mistake. But if you're focused on leverage, you would be doing up to 4 lots. You'd be going like, I can do 2 lots. I have the margin. I have the leverage. This is not, so that's a 51. That's where margin gets you in trouble, is because it's there and traders use it. Don't use margin. Don't use margin. Define your risk by doing percent. So for a 200 pip move, it's just half of the 2 lots, so you just do 1 lot. In the worst case scenario, if it moved 1,000 pips you would do 0.2 lots. So you'd only do 2 micro lots if you thought that the Euro Swiss would move 1,000 pips, or the potential exists that it moved 1,000 pips. That's how the math would come out. 2 micro lots. Now, is that trade worth doing at that time, to make 50 pips on 2 micro lots? And the answer, of course, is no. All right. So what happens if the whole got out at 85, 85 using the 2 lots, the 100 pip move? If you had a 3,500 pip move and it went down to 85, which was the low price for the Euro Swiss, according to my charts at least, you would have lost 6,996 at the worst case scenario. Okay, so even if you ignore the fundamentals, if you ignore the fact that the Swiss National Bank could have taken the peg away, and that would leave to total uncertainty as far as where the price would go. Would it go 100, 200? Would it go 10, 1,000? It went 3,500 pips, more than anyone probably ever thought. You would have still been in the game. You'd still have 3,000 left in your 3,000 of your 10,000 left in your account. You'd still be playing. You'd probably be you'd probably be a little bit skeptical about trading, but maybe you'd be here today learning about risk a little bit more and not taking that position the next time. And that's my hope from this webinar here today, is to open your eyes a little bit to about the risks and understanding about risks even more than yesterday. You must do it. You must do it. So focus on the risk. If you had 1 lot, you would lose 34,000. You'd be in the situation. So you only use 1 lot. You can do 4 lots, fully leveraged up. You would lose 34,000. You'd be sweating that you're in 24,000 in debt, and that the broker is going to come after you with legal advice and ruin your credit for the rest of your life. If you lost 30, if you had the fully leveraged up at 50 to 1, because this is a free bet, the Swiss National Bank will never take away the peg, you're down $136,920. Not the position you want to be in, folks. Not the position you want to be. So I'm going to end it right there. I don't, if you're out there and you lost in this, and it's easy probably for some people to say, "Oh, Greg, that's in hindsight," but I tried to make it as normal a thought process as I would. I was not interested in the trade. When I saw the price move above the 100-day moving average, that raised a lot of eyebrows in my mind. And I always had the fear of it going below the 120 level, and just looking at the price action, it said there's a lot of sellers up here, and this market is is weighed one way or the other. So you got to be careful. You got to be careful. All right, to maintain a Euro Swiss 120, S&B had to be long this pair. Does that mean the S&B has lots of euros? So they bought the euro, yes, and they actually sold their own currency. So they had currencies, Swiss francs, within their on their balance sheet, and they actually sold their own currency. Usually it's the other way around when countries intervene, like in Russia, their ruble is getting hit, and so they try to buy up the ruble, right? And they try to support it But in this case, it was the other way around. So that's the case. All right. I'm going to end it there. I want to thank the people at FX Street for providing me this opportunity, but I think they have another webinar coming up. So thank you all for coming in. If you have any questions or comments, send me an email at greg@forexlive.com. If you want these slides or whatever, I'll send them to you as well. I thank the people at FX Street for providing the opportunity here, and we'll see you next month. Bye-bye now.